Picture this. You've just walked into what is absolutely your dream home. You're already mentally arranging your furniture, you love the neighborhood, you are completely ready to make an offer. But then your lender drops a three-letter acronym that brings the whole thing to a screeching halt. DTI, or your debt-to-income ratio. Look, I know it sounds like some boring, complicated math problem, but as we'll uncover in this explainer, it's actually the single most important tool lenders use to decide if you get the keys. We're going to break this whole thing down so you can confidently walk through that new front door.
Okay, let's dive right into this. Here's our roadmap for today. We're going to look at the DTI snapshot, compare the front-end versus back-end ratios, show you how to easily calculate your own numbers, explore modern mortgage approval limits, and finally, go over some ways to improve your DTI if it's running a bit high.
So, what's really stopping you from getting that dream home? Look, I get it. A lot of first-time homebuyers hit this wall of financial jargon and it just feels overwhelming. But seriously, don't let this acronym freak you out. Your DTI is really just a simple stress test. Lenders use it to make sure that giving you a massive loan won't accidentally ruin your life. They just want to know you can comfortably afford the house and, still afford to eat.
Let's start out with part 1, the DTI snapshot. You can think of this like a giant financial scale balancing the money flowing in against the money you've already promised to pay out.
By definition, your debt-to-income ratio is literally just a percentage. It shows exactly how much of your gross monthly income is eaten up by your debt payments. Why are lenders so obsessed with this? Because they want to see breathing room in your budget. If your furnace suddenly kicks the bucket in the middle of winter, or you need 4 new tires, they need to know you aren't going to default on your mortgage because you were stretched way too thin.
All right, moving right along to part 2. When you actually apply for that mortgage, lenders are looking at 2 totally different versions of this ratio behind closed doors. And this brilliantly illustrates the difference. You've got the front-end ratio and the back-end ratio. The front end is basically just your housing ratio. It's only looking at your future housing costs, like a $1,500 mortgage payment. But the back-end ratio, that's the whole shebang. It takes that housing cost and piles on every other monthly debt you owe: car loans, student loans, credit cards, you name it. So whenever a lender casually mentions your DTI, they are almost always talking about this back-end ratio, because it gives them the full, unvarnished picture of your monthly obligations.
Okay, on to part 3. Calculating your DTI. Now this sounds like something you would hire an accountant for, but I promise you do not need to be a math whiz to do this. Let's run the numbers together.
You literally just need 2 numbers and 3 easy steps. Step 1, add up all your monthly debt payments. We're talking the new mortgage, your car loans, student loans, and, this is absolutely key, just the minimum required payments on your credit cards. But here is what you exclude: your daily living expenses. Things like groceries, Netflix, or your cell phone bill do not count here. Step 2, find your gross monthly income. That's a big number you make before taxes and health insurance get taken out. Step 3, just divide your total debt by that gross income. Simple as that.
Now, what's really interesting is how clear this becomes with a real-world example. Let's say you and your partner bring in $6,000 a month before taxes. You're eyeing a future mortgage of $1,500. Plus, you've got a $100 car payment and maybe $400 in minimum credit card and student loan bills. That brings your total monthly debt to $2,000. If we take that $2,000 and divide it by your $6,000 income, we get 0.33, which means exactly 33% of your income goes to debt. That leaves a huge 67% slice of the pie for living your life, saving up and paying for groceries. Pretty comfortable, right?
So, what do these percentages actually mean to the person writing your mortgage check? Let's jump into part 4, mortgage approval limits, and see what the modern rulebooks actually say.
For literally decades, the gold standard in the mortgage world was this classic 28-36 rule. It basically said you shouldn't spend more than 28% of your income on housing, and your total debts shouldn't cross 36%. If you hit those numbers, you are the perfect candidate on paper, but let's be real, homes are way more expensive now, and modern lending rules have completely evolved to match today's reality.
Let's see how the different loan types actually stack up today. There is a surprising amount of flexibility out there. Conventional loans usually cap out around 43%, but they can actually stretch to 50% if you've got a stellar credit score or a lot of cash in the bank. FHA loans, these are an absolute game changer for first-time buyers because they are incredibly lenient. They often allow DTI ratios of 50% and get this, sometimes even up to 57%. VA and USDA loans usually aim for 41%, but again, they can go higher if the rest of your financial profile is looking really solid.
All right, part 5, improving your DTI ratio. What if you just crunched your numbers and your ratio is running a bit too hot? Don't panic. Let's look at some highly actionable strategies to fix it, and bust a few myths while we're at it.
If your DTI is too high, you essentially have two main levers you can pull. Lever 1, lower your debt. You can use the snowball method, which is knocking out your smallest loan balances completely to instantly erase that monthly payment from your ratio, or you can use the avalanche method to save on interest. Oh, and fun fact, if a car loan has fewer than 10 months of payments left on it, a lot of lenders will just pretend it doesn't exist for your DTI. Lever 2, boost your income. Start a side hustle, ask for that raise, or maybe bring in a cosigner. But whatever you do, please follow this absolute golden rule. Avoid new debt like the plague. Seriously, do not go finance a new car or open a fancy new credit card right before closing. It will absolutely spike your DTI and could instantly kill your mortgage approval.
Okay, here is a crazy insider secret that almost no first-time buyers know about: the gross up. If you receive any non-taxable income, we're talking Social Security, disability benefits, or child support, lenders don't just look at that number at face value. Since Uncle Sam isn't taking a cut, lenders will often actually gross it up by 25%. So if you get $1,000 a month in tax-free child support, your lender treats it like you earned $1,250. That extra phantom income mathematically shrinks your DTI and instantly boosts how much house you can buy. Pretty awesome, right?
Now, we absolutely have to clear up a massive misconception right now. A ton of people think a high DTI ruins their credit score, or the other way around. No way. These are two totally different report cards. Your DTI ratio measures your income against your debt to see how much of a mortgage you can handle. Your credit score? That only measures your past payment history. Think about it. Your credit report literally has no idea how much money you make. So your DTI ratio does not directly impact your credit score at all. Obviously, paying down debt helps both, but they really are totally separate things.
So the crucial point to take away from all of this is right here. Don't max out your limit. Just because a bank looks at a piece of paper and says you're approved for 50% DTI does not mean you should actually stretch yourself that incredibly thin. The lenders in factoring in your grocery bills, daycare, or your vacation fund. You have to be the one to draw the line. Make sure you leave enough breathing room in your real-world budget for savings, having some fun, and covering those completely inevitable emergencies.
Understanding this one single percentage is literally the master key to your home buying journey. It tells you exactly where you stand and what debts you need to crush to get that beautiful clear-to-close email. So grab your phone, total up those minimum monthly debts, divide it by your gross income, and see exactly where you land today. Because ultimately, you have to ask yourself, are your current monthly spending habits building the life you want right now, or are they blocking the door to the home you want tomorrow? The math is completely in your hands.